Most traders believe that price goes up because there are more buyers than sellers. That idea sounds logical, but it is completely wrong. In modern markets, thinking this way is exactly how smart money takes advantage of retail traders. Today, I'm going to show you how price really moves using supply, demand, order flow, and Wyckoff logic in a way you will not be able to unsee. Welcome back to the ComLucro channel. In this video, you will learn why the idea of more buyers than sellers is a myth, where real supply and demand actually exist in the order book, who truly moves price, how liquidity gaps create sharp spikes and crashes, and how Wyckoff's volume versus price logic helps you read the interaction between institutional players and retail traders. But more importantly, you will stop seeing charts as random candles. Instead, you will begin to see a constant interaction between aggressive and passive participants. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let's start by correcting the biggest misconception. Many traders believe that price goes up because there are more buyers than sellers. It sounds reasonable, right? But here is the problem. On any exchange, for every trade, there is always one buyer and one seller. The quantity bought always equals the quantity sold. So it is impossible to have more buyers than sellers in executed trades. What actually changes is something else. Who is more aggressive? Who is more patient? And who is willing to hit the other side's orders? Price does not move because an extra buyer suddenly appears. It moves because one side is attacking while the other side cannot or does not want to absorb that pressure. To truly understand supply and demand, you need to understand two types of orders. First, limit orders. These are patient orders. They say, I want to buy at this price or better, or I want to sell at this price or better. These orders sit in the market and build the order book. Second, market orders. These are impatient orders. They say, execute now, regardless of price. Here is the key idea. Limit orders represent real supply and demand. Buy limit orders represent demand, and sell limit orders represent supply. Market orders are what actually move price. They cross the spread, consume limit orders, and push price up or down. In Wyckoff terms, supply and demand exist in limit orders, while price movement comes from market orders interacting with that supply and demand. Now let's break down what actually happens when price moves. Price moves up when market buy orders hit and consume sell limit orders at the ask. If buyers continue to push, they absorb all available sellers at that level. The next available sellers are at higher prices, so price moves up. If there are short sellers with stop losses above a level, once those stops are triggered, they turn into market buy orders as well. This is how short squeezes happen, forced buying on top of existing buying. Price moves down when market sell orders hit and consume buy limit orders at the bid. Once those bids are gone, the next available buyers are lower, so price drops. Long traders' stop losses turn into market sell orders, creating liquidation cascades. So, the summary is simple. Market buy orders lifting offers create upward movement. Market sell orders hitting bids create downward movement. It is not about more buyers or sellers, but about which side is more aggressive. Price does not move only because one side is strong. Sometimes it moves violently because the other side disappears. Imagine a supermarket where water costs $1. The next day, most suppliers disappear and shelves are almost empty. You do not need a surge in demand for prices to rise. Even a few buyers can push prices higher because supply is limited. Markets behave the same way. If sellers remove their limit sell orders, the ask side becomes thin. Even small market buy orders can push price sharply higher. If buyers remove their bids, the bid side becomes thin, and even modest selling can cause strong downward moves. This is what we call a liquidity gap. Price jumps not because everyone suddenly becomes bullish or bearish, but because there is no one on the other side of the trade. In Wyckoff terms, this is known as no supply or no demand. And these conditions are crucial for understanding where trends can extend or reverse. Now, let's bring in one of Wyckoff's most powerful concepts, the relationship between volume and price. Think of it this way. Volume represents effort, and price movement represents result. You do not need to know exactly who is buying or selling. You only need to compare effort versus result. Now, to reinforce this idea, I want to show you a short clip from experienced trader David Paul, where he explains how price and volume reveal what is really happening behind the market.
So looking at price and volume together is an edge, in my humble opinion. Price is the most important, but you can actually tell from price and volume relationships, and I assure you they're not rocket science, that whether somebody's playing with you or not, the big players can easily manipulate price, but they can't manipulate volume that easily.
Now, what he is pointing out here is critical. Price can be influenced and even manipulated in the short term, but volume reveals the real interaction behind the move. So, instead of focusing only on where price is going, we start asking a better question. Does the effort match the result? Now let's break this down in a practical way. First, high volume with small price movement. This means a lot of effort, but very little result. One side is clearly attacking, but the other side is absorbing that pressure. For example, you might see heavy buying at a resistance level, but price barely breaks above it and fails to close strongly. This often signals strong sellers sitting above the market, absorbing that demand. Second, high volume with large price movement. In this case, you have strong effort and strong result. The dominant side is clearly in control. This can appear as a powerful breakout or as a potential climax near the end of a move. The context will determine whether this is continuation or exhaustion. Third, low volume with a large move. This is small effort with a big result. It usually means the other side has stepped away. That is what we call a liquidity gap. These moves can happen during strong trends or in thin market conditions where there is very little opposition. So every time you look at a candle or a bar, ask yourself this question. Given the effort, represented by volume, is the result in price strong, weak, or suspicious? This is the foundation of reading the market through Wyckoff logic. Now, to deepen your understanding of this concept, I want to show you another example from experienced trader David Paul. Pay close attention to how he explains the idea of validation and non-validation, and how volume and price can move together or start to diverge, because this is where many traders begin to misread the market.
In terms of validation, if you've got a big range bar with above average volume that closes in the top 80% of the range or the top half of the range, then all is good. And in that moment, whatever that moment is, 5 minutes, 1 hour, 1 day, 1 week, 1 month, then you should do your best to let it run. And similarly, if you've got low volume and a very small range, that's also good. That's fine. So small result, small effort. That's good. Everything's in sync. Now, where you get a non-validation is that if you get a big bar on low volume. Now, that can happen easily at a breakout, and it can happen easily at the end of a trend where the price keeps running on low volume. Now, let's look at the housing market at the moment, certainly in the UK, and from discussions with Kathy in the US as well. We've got a situation where prices are rising and volumes are rising. I don't know what it's like in Denmark. Now, sooner or later, you'll find that volumes will stay up there and prices will go flat. That's the next step, and that can happen very quickly. So we'll get if you examine the results carefully, you're going to get a non-validation between the volumes of homes sold and the prices. At the moment, everything's going rosy, but it changes very quickly indeed at the top of a market. That's the next step. Just watch out for that, any of you that are involved in property. Just look at the monthly stats. At the minute, volumes are rising, prices are rising. Certainly in the UK, that's the case. The next step will be that volumes stay up there, but prices just don't go. In other words, you get a flood of sellers into the market. All that volume can't push the price up anymore. And then all of a sudden you get a turn. That's a non-validation, happens in every market. So now this is an interesting one. And this happens frequently at the end And this is what many traders call a volume climax, where you get lots and lots of volume and no movement. And that's the next step in the housing market, in my opinion. Now, what's happening here? Now, this is going to be easy for the Danish people. Let's say that you're in your car on a miserable cold night, right? And there's lots of snow around. And you're going up a hill. Use your mind's eye here. You're going up a hill. And you put foot, as they say in South Africa. And you're moving up. And all of a sudden, the wheels start to spin on the ice. Yeah? And you put foot again. And you go a little bit further, but you can't make any traction. And then you put foot again, but it doesn't matter how hard you put your foot, you slide back. And that's what's called a volume climax. Lots and lots of volume, no action in the price. I think that's probably a quarter to 2 quarters away in the housing market, in my humble opinion.
Now, notice what he is highlighting here. The key idea is not just volume or price in isolation, but whether they are in sync or starting to diverge. When effort and result align, the move is healthy. But when they begin to separate, that is often where exhaustion, reversals, or traps start to form. Now let's connect these ideas to the bigger picture. All of these mechanics, limit orders, market orders, liquidity, and volume, fit into Wyckoff's overall market cycle. First, accumulation. This is where smart money is quietly buying from weaker participants inside a range. You will often see high volume on down moves, but price fails to make new lows. That is absorption of supply. Second, markup. This is where demand begins to dominate. Price starts trending higher. Pullbacks are shallow, and downward moves tend to occur on lower volume. Breakouts in this phase usually show strong follow-through. Third, distribution. This is where smart money begins selling to the public near the top. You will often see strong bullish candles on high volume, but with little continuation afterward. That signals supply overcoming demand. Fourth, markdown. This is where supply dominates. Rallies become weak, upward moves show low volume, and price continues to fall. Your role as a trader is not to predict the future perfectly. Your role is to read what is happening, who is accumulating, who is distributing, and whether the market is in a phase of absorption or distribution. Let's finish with a simple checklist you can use every time you open a chart. First, forget the idea of more buyers and sellers. Instead, ask who is more aggressive right now. Second, think in terms of orders. Limit orders represent supply and demand. Market orders are what actually move price. Third, pay attention to liquidity. When there is low liquidity, even small orders can create large moves. When liquidity is deep, larger orders are needed to move price. Fourth, always compare effort versus result. High volume with little movement suggests absorption. High volume with strong movement shows dominance or possibly exhaustion. Low volume with strong movement often signals a lack of opposition, a liquidity gap. Fifth, identify where you are in the Wyckoff cycle. Is the market in accumulation, markup, distribution, or markdown? And most importantly, are you trading with smart money or are you providing liquidity for them? Once you start thinking this way, you will stop chasing every move. Instead, you will begin to see where large players are active, where retail traders are getting trapped, and where the real opportunities are. Please also remember that the mission of the ComLucro channel is simple. Our focus is to help traders develop clarity, confidence, and structure, so every decision in the market is made with discipline and clear intention. On this channel, you will find complete courses designed as a true trading masterclass. We teach the liquidity concept in trading, the complete guide of market structure, higher time frame analysis, and supply and demand trading strategy principles, always focused on understanding price behavior and executing with a professional mindset. We also explore trading psychology, risk management, and long-term consistency, because trading is not only about charts, it is about mindset, discipline, and structured execution over time. There are no shortcuts in the markets. Real progress comes from continuous study, observation, and practice. Our main courses include smart money concepts, ICT concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside these courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Francis Hunt, and Mark Douglas. whose work has helped traders better understand the structure of financial markets. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are also working on how to become a successful trader. Make sure to subscribe and turn on notifications so you do not miss our latest trading psychology masterclass lessons and deeper insights about the markets. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? Or what topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.